In this video, I'm going to show you the 4 principles I followed to successfully sell cash secured puts. Following these principles allowed me to collect around $61K in premiums for the month of October. And for transparency, that's about a 4.69% ROI on the portfolio. But before we jump into it, remember this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. Now, let's take a look at the portfolio. As you can see here, this is my current portfolio value. Now, if you want to follow along my 8-figure journey, go ahead and click the subscribe button down below if you aren't already subscribed. Also, if you get any value out of this video, please hit the thumbs up button for me, as I would greatly appreciate that, and I appreciate you being here. Now, let's go ahead and go into the realized gain loss so you can see exactly how we did for the month of October. We're in the current month right now, which is November, but we're gonna go ahead and switch the custom date range here. Okay, so you can see, and we're gonna go to October 1st to October 31st, all right? And we're gonna press go. As you can see, 61K in options premiums. Obviously, results vary month to month, year to year, but that was 100% gain loss ratio, and I'm gonna show you exactly how I was able to do that. Now, how did I collect 61K in premiums for the month of October? It came down to these 4 principles, okay? Number 1, understanding VIX, okay, which is the Fear and Volatility Index. If you've never heard of that, then this is gonna be a great video for you, because this is what allows me to understand how much cash I should have on the sidelines, just like Warren Buffett, just like Peter Lynch, just like the great hedge fund managers that typically have cash on the sidelines at every point in the market, okay? I'm gonna help you understand how to take advantage of fear, right? And not be, you have to be greedy when others are fearful and fearful when others are greedy, just like Warren Buffett said. And I'm gonna show you how to navigate around headline risk. Number 2, understanding the overall macro environment. Are we in a bull market? Are we in a bear market? Those 2 things happen, but right now we're in a bull market, and I'm gonna show you how to understand that versus just listening to the fearmongers on the news outlets. Number 3 is understanding and identifying key levels on the chart, relative strength index, and using Bollinger Bands, which is my favorite indicator. And then number 4 is choosing the right options strategy, 90% selling options. So that's what I do in my portfolio. I typically sell options because it's a high probability trade, and it allows me to get paid to dollar cost average. Worst case scenario, I get a stock, a good asset, and I just wait for it to go back up, and I collect premiums while holding those shares as well. And I'll show you exactly how to do it. But this not only worked for me, this also worked for my 619 members here in my private mastermind called Options Trading University. As you could see, everyone's sharing their recent inspiration. Okay, we love seeing inspiration in the group and collaborating in here. Now, if you do want access after this video to my Ryan's Trades channel and my Leaps, Entries, and Exits, that'll be at the top of the description down below. Also, I do give away free trade ideas here on my Instagram, my X account, and my free newsletter, which are also all down below in the description. Be sure to be subscribed to all 3 of those, because I give away free trade ideas on those every single week. Now, let's go ahead and get back into it, okay? The first thing is understanding the VIX. So the Fear and Volatility Index, what is it? How does it work? Why do we look at this? Well, when the VIX is high, options premiums are usually overpriced, okay? So options are fear-based products, right? People buy put options because they think the market's gonna go down. They wanna protect their portfolio, right? And usually 95% of the time, the market tends to go back up and people lose money on those put options that they purchased. Well, who is selling those put options? Well, it's people like me. I'm selling those put options because I understand there's a high probability that the market's probably gonna bounce back and go back up, and these options are overpriced. So giving me a key advantage. Now, these are the different levels here on VIX, VIX 12, VIX 12 to 15, VIX 15 to 20. As you can see, as the VIX gets higher, the fear goes higher, and the cash levels that I have on the sidelines also go lower, okay? So when fear goes high, my cash goes lower because I'm allocating that cash towards positions as the market is coming down, okay? So you don't want to buy high, you want to buy low. So let's take a look at the VIX chart so you can understand what I'm talking about, okay? So we're taking a look at the VIX right here. And as you could see, not too long ago, back in April, during 2025, so depending on when you're watching this video, but back here in April, we had the tariffs crash, the fifth fastest stock market crash in history. And the VIX spiked all the way up to 60, okay? This is the highest we've seen it in quite a while. If you go back to there was one time before in August 2024, and then the previous time was during the 2020 COVID crash, okay? So it's rare that we see the VIX spike up this high. And when the VIX spikes up that high, that's basically the best opportunity to invest in the markets and take advantage of the fear, sell options, buy call options, and do all of the above. Because look what happened to the market, okay? We're gonna take a look at QQQ here. All right, so on that day, as you can see, April 7th, that was the bottom in the crash, okay? So we'll go back to VIX. You could see April 7th, VIX spiked up to 60, and April 7th on QQQ, which tracks the NASDAQ 100, that was the bottom, okay? So of course it's hard to, when fear is high like that, it seems like the world is gonna end and the market's gonna go to zero, but that is actually the best time, okay? And for everyone who purchased down here, in fact, I sold a lot of options and I bought some leaps options and stuff like that, right? And we made good returns, in the next few days because the market went back up and has gone up higher ever since. So we want to take advantage of VIX being high. And when VIX is low, we want to have more cash on the sidelines. So if we go back to these levels, you could see that VIX under 12 is extreme greed. This is when the market's at all-time highs and everyone thinks it's going to keep going higher. I like to have 40 to 50% of cash on the sidelines. VIX 12 to 15, which is just straight greed, 30 to 40% cash. VIX 15 to 20, which is where we're currently at, slight fear, 20 to 25% cash. VIX 20 to 25, 10 to 15% cash. And then obviously it goes all the way up to VIX above 30, which is 0% cash. And I'm adding new cash to the brokerage account from my checkings and savings, okay? So like when the VIX spiked up to 60, I actually added in 100K that day to the portfolio. So that's what we want to take advantage of. Now, it's interesting because in the current environment, and depending on when you're watching this video, it might be different, but right now, the VIX is about roughly at 20. We'll just say it's at 20, okay? So essentially, if we go back to the VIX cash allocation levels, if we say, hey, VIX is at 20, I could have 10 to 15% cash on the sidelines. That's currently where I'm at. I have about 11% cash on the sidelines. So I'm very aggressive here, because I'm taking advantage of the fear. Because when the VIX spikes, it tends to go back down. Okay, so when VIX spikes, right, fear spikes up, it tends to go back down and fear subsides. So I expect the fear to subside in the next week or two. Okay, and the same thing happened even during the tariffs crash. Okay, fear subsided, VIX spiked up to 60, and then the fear subsided and the VIX came all the way down to about 17, okay? So that just tends to happen with fear, right? Fear gets overstated. Now, how do we take advantage of that, okay? So let's go ahead and move on to the next step, understanding the macro environment. So, it's different when the fear is spiking, but the Federal Reserve is increasing interest rates like we saw in 2022, which led to the 2022 bear market. Okay, so we have to understand what type of environment we are in as far as money goes, right? Money is controlled by the Federal Reserve. They either increase interest rates, which is bad for the economy because, right, the higher interest rates, people aren't taking out mortgages, they aren't borrowing on credit cards, they aren't borrowing money, businesses aren't borrowing money to expand the business because the cost of borrowing is too high. Right? And that tends to dry up liquidity. People sell off their assets and put it into 10-year treasury bonds, which are a risk-free asset because they're paying out higher a higher interest rate, right? So right now we are in a lowering interest rate environment. That's why the market is going up, because businesses and consumers can borrow at cheaper rates, and that money ends up going into the economy and flooding back into assets, into the stock market. Okay, so what I like to look at is the CME FedWatch tool. Now you can find this on cmegroup.com, okay, /market/interest rates. And this will show you basically if the interest rates are coming down. So current rates, okay, you could go to the current target rate. Current target rate is 3.75 to 4.0 percent, okay? And if we go to the aggregated, you could see that next month, or actually in January of 2026, we're getting a quarter basis point interest rate cut, okay? The target rate will be between 350 and 375 basis points, okay? So 82% odds that that's happening. Every time, this tool is extremely accurate. Every time we're going into an interest rate cut meeting, the week of, as long as this number is above 55%, 100% of the time, it has been correct in predicting a interest rate cut, okay? So if this is at 82%, the week of going into an interest rate cut, we will be getting an interest rate cut. This has been correct since 1998. So this is a very accurate tool, and I like to keep looking at this to make sure, the market is pricing in interest rate cuts in the futures market, okay? So 82% chance we get one in January, maybe another one in June of next year, and then another one potentially in October of next year. So 3 interest rate cuts on the way for 2026, and potentially another one in 2027. So we are in an interest rate lowering environment, okay? The Fed is trying to stimulate the economy, but not fast enough to spark inflation, right? So it's a very tender balance there. Now, as you could see, right, ever since we can go back to the bear market, okay? The bear market was back here, December 2021, actually November of 2021, the Fed announced, hey, we're going to be increasing interest rates because inflation is getting out of control. So they want to take money out of the economy, and the market went down, right? And then here in 2023, they announced, hey, we're going to start lowering interest rates. And ever since then, the market has just gone up, okay? Of course, we get crashes along the way, but those are good opportunities to take advantage of, right? So now that you understand the macro environment and how the market works, you could be better prepared to manage your portfolio, right? You could say, hey, if the Fed announces they're going to raise interest rates, that might be a good time to take off positions, right, and go into cash. But for now, because we're getting those interest rate cuts, not too worried. Of course, the market dips and has little crashes and corrections along the way. And the news outlets, again, like to scare people out of their positions, but we have to stay strong and take advantage of the fear, okay? So that is understanding the macro environment. Another thing is looking at the 200-day moving average, this blue line, okay? When we go below that, it is worrisome. We did that during the tariffs crash. We went well below it. So, just another thing to kind of look at and keep that in your arsenal. But even though we went below it, because the interest rates were going to be cut, eventually we recovered, and we recovered a lot faster than I anticipated. So that is understanding the macro environment. Now, another thing is identifying key levels on the chart. So we're going to go into a specific chart, a specific stock that I've been trading for a long time, and it's been a very good stock in the portfolio. And we're going to look at RSI, Bollinger Bands, okay? So Relative Strength Index is a momentum oscillator that measures overbought and oversold conditions. So we don't want to be buying or selling options when things are overbought, because things tend to come down, right? Now, we do like to buy or sell options when the stock is oversold, because, people are max fear, right? That is, it's showing that, hey, we have to be greedy when others are fearful. So if it's trading above 70, the stock is very overbought. If it's trading below 30, stock is very oversold. The Bollinger Bands measure how drastic price changes are and the probabilities that the price will revert back to the mean. We'll take a look at the chart so I can explain to you exactly what I'm talking about, okay? So the first thing, RSI, okay? This is TradingView. So if you want these indicators. You can create a free account on TradingView. And then you're going to go to indicators, and you're just going to type in relative strength index, and you'll see right here, okay, you could pop that on the charts, all right? And that's going to pull up this purple bar. Now, this purple bar is cool because it'll show you where things are overbought. Like back here on SoFi, we're taking a look at SoFi Technologies. What I like about this stock is it's lower priced, okay? It's currently a $27 stock. But it's a very good fundamentally sound stock. So this is an online bank. They have a stadium, SoFi Stadium here in California. And basically what they do is their main bread and butter in the past, and even right now, is refinancing student loans, helping out students in college refinance their loans at a lower rate, mortgage refinancing, auto loan refinancing, that kind of stuff. But they also have expanded into, a full-blown financial platform with high-yield savings accounts, crypto, options, that kind of stuff. So it's a very good stock fundamentally. PE ratio is at 50, okay? And when we're looking at the RSI, we could see back here, the stock went from all the way, like if we look at percentage-wise, the stock went from $15 up to 25 in just 1 month, okay? So that was a 64% increase in the stock price, and you could see that it was very overbought, okay? So it's more risky in these situations, especially right here, like people who are buying at $25, right? In the next day, they saw a decline in their share value, okay, from $25 all the way down to $20. So their share value went down 18% in 1 day. So you have to be careful when things are in these overbought conditions because they could be very volatile and come back down a lot, okay? Now, when they're oversold, like back here during the tariffs crash, right, we saw that the stock was all the way down here at 30 on the RSI, which is oversold, and down here, 30, right? And those were two very good purchasing points right here and right here, because look what happened. The stock went back up for a good period of time. And then obviously, once the tariffs crash was over, the overall market went up, but SoFi, that was the bottom, right? That was the bottom, and it's gone up ever since. So we want to take a look at the RSI. Now, if we're taking a look at it recently, I would say the RSI is right in the middle of the range. That's a perfect area to sell some cash secured puts. The stock's not overbought, but it's not oversold. It's just kind of in a nice range, okay? So that's one indicator I like to look at. Now, another one is called the Bollinger Band. So if you go to indicators and you type in Bollinger Bands, okay, and then you pop that on the chart, that's going to pull up this kind of cloud area around the candlestick. So there's a bottom line, a middle line, and a top line. Now, the bottom and the top line are 2 standard deviations away from the average price. Now, what does that mean? Well, in basic terms, that means that the stock will stay within these bands 95% of the time. And 5% of the time, it will go outside of these bands. So like right here, it briefly breached the lower Bollinger Band, okay? SoFi did right here. And look what happened. It reverted back to the mean. It sucked back into the Bollinger Bands, right? It sucked back into these, close to this middle line. And that typically happens every time that this thing gets close to that lower Bollinger Band or breaches it. You could see down here, right? Almost touched the lower Bollinger Band, then sucked back up. Right here, almost touched the lower Bollinger Band, then sucked back up, okay? And even on the upside, this thing broke the upper Bollinger Band by a lot and then sucked back in, okay? Did it again here and then went back down, right? So I like to look at these Bollinger Bands, right? It did that here and here as well. So something to look at just for trading entries, okay? Sometimes you don't want to be selling cash secured puts or buying shares or buying call options, especially when the stock is above these upper Bollinger Bands, okay? It's not a good entry point. And most of the time, you're probably going to get, the stock is going to revert back to the mean or the average price, okay? So that's why I like Bollinger Bands, because it's a statistical indicator that just shows you based off of average prices where the stock should be trading, right? Where it should be trading based off of average prices. So that's another indicator that I use for entries and exits, okay? So now that we've went over the indicators, all right, now we could look at the next thing, which is choosing the right options strategy. Now for me, 90% of my portfolio is selling options, selling put options, getting assigned shares, and then selling covered call options against my shares, okay? The reason I do that is because I like collecting premiums every single month, okay? And it's a strategy that allows me to control my returns. So my returns, I typically shoot for 3 to 5% per month. Obviously, results vary, but I've been able to do that for the past 5 years. Now, I'm trading off potential upside, like for instance on SoFi, right? If we go back to SoFi, all right, just buying and holding the stock from here to where it's trading at now would have been a 219% return this year, okay? Just buying and holding. So yes, of course, that would have been a better strategy just to buy and hold, but no one knows how much higher the stock is going to go. There's been very good instances, like on one of my favorite stocks, NVIDIA, right? Right here, at this point, I'll draw it right here, I thought the stock was gonna go much higher, like this, right? But no one knows where a stock is gonna go, even if it's the best stock in the stock market, like NVIDIA, right? And what happened, the stock went down for quite a while, okay? Went down, and then now it's finally recovered. So for me, I rather be able to control my returns and getting that 3 to 5% per month or 30 to 50% per year. Results vary there, but being able to control the returns allows me to consistently compound, okay? Because I don't know if a stock is gonna continue going up, but I do know that if I'm selling an option, I'm able to collect a premium for a certain return on risk. And, at the end of the month, I have more premium and cash in the account, okay? So that's why, typically on this run, I've probably made somewhere around 50 to 60% on SoFi. But, if I were to just bought and held, 219%. But again, we don't know if a stock's going up or down. No one knows, okay? I just try to run the wheel or sell cash secured puts on good companies to where I can consistently generate premiums monthly, because that's a good retirement strategy, right? Buying and holding is not a retirement strategy because you don't control the outcome. You're just hoping and praying that the stock goes up. But if you needed consistent, you have bills every month and you're retired, how are you going to generate income or premium from the stock market? Well, you do that with cash secured puts. So that's why I trade this strategy, okay? So let's talk about when you're first trading options, you should not be buying them, okay? That's a gambler's mentality, is buying options, short-dated call options, which a lot of people do, okay? And you're gonna see that. It's very popularized on the internet. But once you get to my level, where you've been through that, you've been buying options, losing money, and doing all of that gambler-type strategies, right? Then you come to the realization that you should probably be selling vertical spreads, cash secured puts, and covered calls, okay? So that's why now 90% of my portfolio is selling options. 10% will be buying options, which I'll show you at the end of this video, but it's with a very specific strategy, okay? So this ensures you're winning 80 to 90% of the time versus losing 50 to 75% of the time with buying options and relying on stop losses. I don't do stop losses. I don't need stop losses. My stop loss is, hey, if the stock falls below my put price, which I'll show you in a minute, then I just get assigned the shares. I just get assigned a very good asset at a discount, and I wait for that asset to go back up, okay? So you can buy options when you get more experience, and I'll go over an example. But let's go ahead and dive into the cash secured puts, okay? So what I like to do is sell 25 to 35 delta put options. What does that mean? 25 to 35 delta means it has a 25% chance of me getting assigned 100 shares or 35% chance of me getting assigned 100 shares, okay? So let me go over it based off of this chart, all right? So let's just say a stock's trading at $100, okay? It's trading at $100. I'm gonna sell like a 95 put option, and let's just say it's a 25 delta. So it has a 25% chance of going below that price, but it also has a 75% chance of the stock not going below that price. So, I'll sell a 95 put, collect $500 in premium, right? And 30 days goes by, and let's just say the stock goes down to 97. So it didn't go below 95. I collected the 500 and I could do it all over again. I do it the next month. The next month, the stock goes up to 102. Cool. Didn't go below 95, collect the 500, and then I do it all over again. Now, the third month, okay, I sell that 95 put option right here, but the stock goes all the way down to 90. Well, now I'm forced to buy 100 shares at 95. I collect the 500 in premium. That's guaranteed to me, okay? But now I own 100 shares at $95, even though the stock's at 90. So now I have to wait for the stock to go back up. But while I do that, I can collect covered call income, which we'll get into in just a moment. So I typically like to sell cash secured puts 30 days out to collect monthly premiums, and that should yield between 3 to 5%. Good chart, good PE ratio, 50 or under, or 100 or under. But let's go ahead and talk about, we'll do it on SoFi, okay? So let's go into the account. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary, but if we go into the account, okay, you're gonna see that I have a SoFi position right here. 194K in cash secured puts. So this is a very big position in the portfolio. Now, if we go, you could see I have the 27.5s, the 28s, and the stock is trading at 28.21. So it's getting very close to my cash secured puts that I might get assigned on. But I sold all these puts to collect about 5K in premium. All right, so what I'm gonna do is I typically like to go out 30 days. So we're just gonna go out to this 34 day because there's no 30 day. So we'll go out there, okay? And I'm gonna go to, let's just say somewhere between 25 and 30 delta. So we'll go to this 25 strike, which is a 26 delta, has a 26% chance of me getting assigned the shares at 25, which would cost me about $2,500 in collateral, okay? But I could sell this put option by clicking the bid right here, all right? And I would collect about $122. Now I know it says $1.22, but you have to multiply that by 100 because there's 100 shares per contract. So 122 bucks, right? $2,500 worth of collateral, and the ROI, the potential ROI there is 5.2%. So you see how high the ROIs here are on SoFi, okay? Now obviously that's results vary based off where the stock's at, but that's a very good ROI, right? You could only imagine and do the math how much, if you were compounding at this ROI percentage per month with your portfolio, right? Where would your portfolio be at the end of the year, okay? So that's a good, test to run for yourself. So I like that, the 25 strike, it's safe. If we go to SoFi, I'll show you how low 25 is. So 25 is gonna be all the way down here. Okay, we're gonna draw that line. So the stock basically has to go down, all right? The stock has to go down from here about 10% for me to get assigned. So if I sell this 25 put, the stock has to go down 10% from today's prices for me to get assigned. Now, that's awesome. I got a 10% discount from current prices, and from all-time highs, I got a 23% discount on a quality company that has good fundamentals and earns a profit, right? That is probably headed higher. But even if it's not headed higher, okay, like let's just say, I get assigned at 25 and then at the end of 30 days, it goes only to 26, I still keep the whole premium, right? Or I still got the shares and now my shares have appreciated, right? And I get to sell covered calls. So let's talk about that, all right? So you see the point of selling cash secured puts. If it goes below, I get assigned 100 shares. If it goes higher, I don't get assigned 100 shares. I keep the premium. I keep the premium either way. In this position, I keep the premium. In this position, I keep the premium. But the difference is I don't have to buy the 100 shares if it just goes up or stays above 25. If it goes to 25.41, I don't have to get the shares, okay? So I love this strategy. It allows me to collect premium consistently. So I like it. Now let's go ahead and talk about the next strategy. So we talked about, well, what happens if the stock goes below our cash secured put? We get assigned the shares. Now what? We're stuck with shares at, potentially the stock is even lower than where we got assigned, right? And oh no, that's not a good thing, right? No, it is a good thing because now I could sell covered calls in case of assignment. So what happens is, let's just say I got assigned here at $100, okay, or $25 on SoFi, and the stock went down to 23, I could go sell a covered call up here at 26, 27, 28, get some appreciation. And if the stock goes above my covered call at, let's just say 27, right? I got $2 of appreciation per share on my shares, plus I got paid a premium. So it's double the premium, right? It's double the income. You sell the shares at a profit because your shares get called away, and you get that premium for the covered calls. So I like to sell 30 delta covered calls, 20 to 30 days out for monthly income, and I enter on green days. And I just wait until expiration, let the shares get called away. Or let's just say, I have the shares at 25. I sold a 27 covered call. The stock goes up to 26. By the expiration, I keep the premium, and then I sell another 27 covered call, okay? Now, that month, let's just say this SoFi goes up to 30. I will have to sell my shares at 27 and keep a premium, which is good, okay? So I typically wait till expiration. So let's go ahead and go into the options chain, and I'll show you. Let's just say we got assigned at 28 today, okay? We got assigned at 28 because that's where the stock's trading. I got assigned. Now, what I typically would do is I would go to the 30 delta, okay, which is the 32 strike, all right, and I would collect about $100. So that's over 3%, okay, over 3% return ROI on the covered calls. Results vary there, obviously, based off where the stock is trading. But so not only would I collect a potential 3% ROI for selling this covered call against my 100 shares, if it goes up, let's just say it goes up to 33, I'm going to have to sell at 32, but I also get the appreciation from 28 all the way up to 32, okay? So that's a 4% appreciation, right? That's a $4 appreciation from 28. So times 100, that's $400 plus another 100, which is 500, right? For that trade. So that's probably close to a 10% return on the upside, which is pretty insane, okay? So actually it's over 10%. So I really like that. It's a really good trade there. So that's typically how I do the covered calls, and I tend to make more money on the covered call side, okay? Now, I prefer to be on the put side because I don't have to tie up capital, but I typically make more on the covered call side when shares get called away. So that is the covered call strategy. Now let's talk about how I increase returns, okay? So I talked about 90% selling options. Well, I also purchased some options in October, okay? So I purchased some options in October, and we're gonna talk about how I did that. So I buy a 70 delta leaps call option 1 year out. Stock has to be below middle Bollinger Band, close to the lower Bollinger Band. VIX has to be above 15, and I sell once a stock is above the middle Bollinger Band. So let's talk about all the fear, okay, because I didn't cover this, but in October, okay, October 10th, stocks end sharply as U.S.-China trade tensions resume, okay? October 14th, Wall Street's fear gauge surges to highest level. And then there was some banking issue where some banks got liquidated on October 20th. So on those instances, VIX was spiking in October. So VIX went well above 15, went up to 20. In fact, it went up to 28 over here. All right, so when that happened, right, this happened October 10th, market fell. We'll look at SoFi. SoFi on October 10th, okay, went from 29, all right, it went from 29 right here all the way down to 26, which was about a 12% correction there, okay? And the stock was near the lower Bollinger Band, okay? It was near the lower Bollinger Band. So what I did there was, had the group. I played Robinhood, but, what I would have done on SoFi was I would have purchased leaps here, okay? And then, because near the lower Bollinger Band, and then I would have exited right here, okay, when it's above the upper Bollinger Band. So that would have been like a 10, 20% ROI on some leaps in 1, 2, 3 days. All right, and that's typically how I do it. So I would go to SoFi, all right, and I would go out to, more than 365 days. The reason I do this is because I like to buy time just in case I'm absolutely wrong or we enter a crash of some sort and I have to wait. I don't want to lose money. So I just pay for time, because if you pay for, if you go out 48 days, let's just say, for a call option, a 70 delta call option, which would be the 26 strike, your theta decay is $2.38 per day. okay? You're losing $2 per day. And let's just say day 20, we have a crash, right? And the stock needs 3 months to recover. Well, you know, this is going to be worth nothing. Basically, I would lose all my money, okay? Now, if I go out 426 days, yes, I'm paying way more. I'm paying $1,000 versus paying, how much was that? It was like $400, okay? So I'm paying almost triple for time, but the theta decay is only, on a 70 delta, is only 9 cents versus $2, okay? And actually 90 cents versus $2, okay? So it's the theta decay is half, plus I have more time to be right. So I like to do that. So I'd, buy the 25 or the 70 delta. I know it's 72 delta, but I would buy 25 strike, 72 delta, and I would pay $1,000 to control 100 shares. If I wanted to buy 100 shares today, that would cost me $2,800. So I get to control almost, I get to control 100 shares for 3 times less and have that kind of leverage factor. So when the stock goes up, I'm seeing a lot of appreciation. So that's typically how I trade the call options. And if you want to learn more, I put a video right here on the Leap strategy. This is my Leaps masterclass. So check that one out, and I'll see you in the next video. Take care.